Ladies and gentlemen, good day and welcome to the LIC Housing Finance Limited Q4 and FY25 earnings conference call, hosted by Axis Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital. Thank you, and over to you, sir.
Thank you, Manav. Good day, everyone, and welcome to this earnings call. We have with us from the management team Mr. Tribhuwan Das Adhikari, MD and CEO, and Mr. Lokesh Mundra, CFO, to take us through the key highlights of the results, post which we'll open the floor for Q&A. Over to you, Adhikari, sir, for your initial remarks, please.
Yeah, thank you, Praveen. Very good morning to all of you and welcome to the post-earnings conference call of LIC Housing Finance Limited for Q4. As you are aware, LIC Housing Finance Limited declared its Q4 results yesterday. And now, before I start the highlights of the Q4 results, I would like to outline a few developments in the economy of the last quarter. The Reserve Bank of India's MPC enacted two successive 25 basis point reductions in the repo rate during 2025, lowering it from 6.5 to 6.25 in Feb, and further 25 basis point cut from 6.25 to 6.0 in April. Despite these cuts, liquidity conditions remain constrained in Q4 of financial year 24-25, Jan to March, contributing to higher market yields. To address this, the RBI introduced multiple liquidity boosting measures in March 25, including a $10 billion INR buy and sell swaps. Then there were OMOs worth 1.8 lakh crores and variable repo rate auctions. The cumulative 50 basis point rate cut combined with the improved liquidity from these interventions led to a decline in market yields during Q1 of the current fiscal, that is 25-26. And due to an increase in the borrowing costs, the company, LICHFL, increased its benchmark lending rate, or LHPLR as we call it, by 10 basis points with effect from 1st January 2025. And subsequently, after the repo rate cut, the PLR was reduced by 25 basis points with effect from April 28, 2025, which affected the entire portfolio. With this, we present the financial highlights of the company for the quarter as follows. The total revenue from operations at rupees 7,283 crores as against 6,936 crores for the corresponding quarter of the previous year, registering a growth of 5%. The total loan portfolio stood at 3,07,732 crores as against 2,86,884 crores as on 31st March 2024, reflecting a growth of 7.38%. The individual home loan portfolio stood at 2,61,562 crores as against 2,44,205 crores, up by 7%. And this individual home loan portfolio comprises 85% of the total portfolio. Total disbursements for the quarter were 19,156 crores as against 18,232 crores for Q4 of FY24, by 5%. Out of that, disbursements in the individual home loans, 15,383 crores were individual. Out of this total disbursement of 19,156, 15,383 crores was as against 14,300 crores for Q4 of FY24 were individual home loans, which was up by 8%. Project loans were at 875 crores compared with 1501 crores in Q4 of FY24. On the net interest income, the NII was 2166 crores for the quarter as against 2000 crores for Q3 of FY24. So sequentially there was a growth, but it was 2238 crores for FY25. So there was a decrease. Net interest margins for the quarter stood at 2.86% as against 2.70% of Q3 of FY25 and 3.15% of Q4 of FY24. PBT stood at 1769.58 as against 1476.18 crore, registering a growth of 20%. PAT registered a growth of 25% approximately. It stood at 1367.96 crores as against 1090.82 crores. And for the year, the PAT stood at 5,429.02 crores as against 4,765.41 crores, showing a growth of 14%. Dividend declared by the company was 500%. Again, that is 10 rupees per share, face value being 2 rupees. In terms of asset quality, the stage 3 exposure at default stood at 2.47% as against 3.31% as at the end of 31st March 2024 and 2.75% as on 31/12/2024. So the asset quality has been continuously improving. Total provisions as on 31/3/2025 were 4,899 crores, with stage 3 PCR, the provision coverage ratio, coming to 51%. On the recovery front, with the continuous and focused efforts, we have witnessed a significant and consistent reduction in delinquency levels during the last year. Also, during the year, we have made a technical write-off of 171 crores during Q4 and 1,368 crores during the entire financial year. On the funding side, the cumulative cost of funds stood at 7.73% as on 31/3/25 as against 7.78 as on 31/12/24. So sequentially, there was a decline of 5 basis points. And as compared to last year, which was at 7.76, there was a decline of 3 basis points. Incremental cost of funds stood at 7.73% for the full year and 7.66% for the quarter. Net interest margins for the year stood at 2.73 as against 3.08%. During the last quarter, the interest rates were elevated due to tight liquidity conditions. However, we managed to keep our interest rate expense flat in compared to Q3. We also renegotiated on some of our outstanding borrowings. These were the earning highlights, and with this brief introduction, I would like to invite you for your queries. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have our first question from the line of Maruk Adajania from Nuvama Wealth. Please go ahead.
Hello. Hi, sir. So I had a couple of questions. You did say that you have changed your PLR as of 1st April by 25 basis points. So now the entire individual loan book has repriced. And is that correct?
Yes, it is correct, Maruk.
Okay, and so in terms of cost of funds, which was 7.66 incremental in the fourth quarter, what is it as we speak today? Because the yields have already found.
Cost of funds have come down after the repo rate thing, around about 7.3.
So the increase, so 7.3. So basically 7.66 has gone down to 7.3, and the yield has gone down on the individual home loans by 25 basis points. And so I just wanted to understand, I know you had explained even on the last call, that how soon do you pass on the repo rate cuts? What's the pricing mechanism?
No,
so you passed on the previous 25 basis points, but there was one more 25 basis points. When will that be passed on to existing customers?
No, Maruk, like banks, many of the banks, the housing loan rates are linked to the repo rate. And so automatically, wherever there is a repo rate cut, the benefits are automatically passed on to the borrowers. But in our case, we don't have that. We have something called the LHPLR or something, a PLR we can call it. So we do assess our because ultimately how much we are able to pass on relies primarily on our borrowing costs, right? So if we see that the borrowing costs are transmitted, the reduction in repo rates are also transmitted to us in the form of lower borrowing costs, we do take a call and pass on the reduced borrowing costs to the borrowers. So that is a call we take from time to time. So it is not automatically linked to the repo rate that as soon as the repo rate comes down, we have to bring down our PLR.
Good morning, Maruk. I am Lokesh Mundra, CFO. This year only.
Good morning.
I understood your question that this reduction in lending rate or So that will be effective on quarterly basis. So this quarter it will not be affected, and next quarter from 1st of July, the effect will come.
Okay, so the next repo rate, so there were two, one has been passed on and one will be passed on in July. That way.
Yeah.
No, we are not confirming that. We'll take a call in July as to how our borrowing rates have leverage as compared to the rate cut, because in June there's an MPC. In June I'm personally expecting a rate cut of another 25 basis points. So we'll take a call in June. We'll take a call in the month of June. This rate cut which we have effected in April, this will automatically be passed on from the 1st of July.
Correct.
Because many of the loans get reset every quarter. There are some loans which get reset every month. So that is a slightly smaller percentage. So that those loans would have already been reset. A majority of the loans get reset quarterly. So those would be reset on the 1st of July.
Correct.
Got it, sir. Very clear. But just historically, if you see in the earlier rate cut cycles, of course, we did not have repo linkage then even for banks. How long does it take to transmit cuts? So if, say, RBI is cutting rates today by 25 basis points, historically, how long has it taken before that fully reflects in your cost of funds and is then fully passed on to borrowers? Any such data you could share?
I don't have any specific data as to when we have passed on the rate cuts in the earlier cycles, etc. But usually, I would say it would be, I think, a three-month cycle, because as it is, the reset is quarterly. In most of the loans, almost majority of the loans, the reset is quarterly. So normally, it takes about 3 months to pass on the rate cut to the borrower and rate to get effected, or the borrower to feel the effect of the rate cut.
Okay, sir. Thanks a lot. Thank you. That was my only question related to rate cut. Yeah. Thank you.
Thank you, Maru.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to take questions from all participants in the conference, please restrict yourself to only 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. We have our next question from the line of Sameer Bhise from Demon Asia. Please go ahead.
Hi. Thanks for the opportunity and congrats on a good set of numbers. So just kind of probing on the whole interest rate things again. Given that we have partly passed on the rate cut on the asset side right now, do you think there is a case that as we go down the rate cycle, there could be a period when in the or at least in first half of F26, we could have a bit of a compression on spreads, which is probably more pronounced than before, and then hopefully we recover towards the end of the year. Is this the right way to think about it?
Well, Sameer, yeah, the interest rate scenario right now is very, very volatile with rate cuts happening and transmission of the rate cuts to the borrowers, and again transmission of the rate cuts in the form of borrowing costs. It's all very, very, I would say, murky right now. But yes, the trend has clearly seen from the actions of RBI and from the market expectations that the trends are for a lower revision, revision in the repo rates. But we are looking at how it gets transmitted to the borrowing costs. As I said, the borrowing costs are right now at 7.3. Down from around about 7.66, so almost 30 basis points. Out of that, 50 basis point rate cut has been passed on to us. We'll have to take a call. Yes, margins are going to be under pressure. I'm very sure of this, and it will require very deft handling on our part, managing the, I would say, the interest rate scenario, so that we do not lose out on the spreads and the margins. I feel we should be able to handle that. We have ended the year with a NIM of 2.72. I think we should be in that region. So my guidance for the year
on a full year basis.
Beg your pardon?
So this is on a full year basis. We ended at 2.7273.
Yeah.
How should we look at probably if we could give some sense on how the transition could be through the year?
Yeah, through the year, my sense would be worst case scenario would be probably at 2.6. best case scenario probably at 2.9. So my guidance would be between 2.6 and 2.6 and 2.8, not 2.9.
Okay, sir. Okay. This is helpful. Thank you and all the best.
Thank you.
Thank you. We have our next question from the line of Gaurav Kochar from Mary Assets. Please go ahead.
Yeah, hi, sir. Good morning. So again, probing a little bit more on margins. So you called out that there has been a PLR reset of 25 basis point, and you also mentioned that the incremental cost of fund, which was 7.66 in Q4, has come down to 7.3. So is it fair to believe, or is it correct way to look at it, that whatever benefit you get on your cost of funds, only that will be transmitted on the PLR? So let's say if you take a call on the further PLR rate cuts that you'll be doing, that will be solely dependent on how much funding cost benefit you're getting. So in that scenario, if that is the case, in that scenario, what is the spread that you're looking at that you would like to maintain on a going forward basis? Maybe if not quarterly, maybe from 1H and 2H, taking these two separately, where do you think your spreads would likely bottom out?
Yeah, well, quite naturally. I think I hate taking money out of my pocket, so asking me to take money out of my pocket and giving it to my borrowers and thereby increasing my margins and spreads, so that's not the right way to do it. Yes, we would be looking at on whatever sort of rate concessions we get in our borrowings onto the borrowers. We've done 25 basis points. Yes, as I said, 7.66 to 7.3. That means almost 36 basis points is what the borrowing cost has reduced by. We'll look in the coming days. Let's see what happens in the June MPC. In the coming days, we'll see if we can pass on this to the borrowers as well. So definitely, whatever benefit we get in lowered borrowing cost as a result of the repo rate reduction will be passed on to the borrowers. And what was the second part of the question, Gaurav? If we can just...
any spread that you would like to maintain. Today, let's say you're doing 2% spread, the difference between your yield and cost of funds. Would you like to say that probably maybe 190 or any number that you'd like to call out? Would you like to maintain that kind of spread?
Right now, we are at 2.06. Yeah. 2.06. We'd like to maintain that. For that, two things need to be done. Yes, we got to be aggressive as far as borrowing is concerned, but of course, borrowing depends on market conditions and T-bill rates and a lot many other things which are not in my control. So that would be market driven. Till there, since we are the biggest HFC, we have a AAA rated status, we would try to negotiate with our borrowers for better rates, number one. And on the other part, as far as the lending cost is concerned, yes, I do agree that we are a company which is mostly focused on individual home loans. Our competition is mostly with the banks. The banks have an advantage of lower cost of funds because of the CASA deposits they hold, which are very low cost funds. So competition in the individual home loan sector is very, very intense. The rates, they're already down to 8% for new loans. Right, being a big player in the market, we cannot afford to set our rates higher than what is there in the competition, because then we lose business, we lose growth. So it is going to be a very tight balancing act. But what we need to do, I believe, as a company, we need to sort of enlarge the sales of whatever we are selling to more margin accretive segments. Like IHL, as I said, is very, very competitive. Yield, the margins are very low in IHL. But there are other segments like if I talk about the LRD and the LAP part of it, where yields are much, much better. Project finance is one sector where the yields are much, much better. Affordable housing is another segment where the yield is much, much better. We have done it last year and we have seen some traction. For example, if I talk of project finance, last year my loan growth was almost 47.5%. If I talk of the LAP and the LRD book, my growth was almost 20%. So we have been focusing there. But again, this book is small in size, comprising about 15% of my total book, because 85% is housing loans. So we have to diversify into that segment and at the same time aim for lower borrowing costs so that my spreads, which are at 2.06, remain at that level. So I would say we would keep the spreads in the region of about 2%.
Okay, sure. And so just last on the funding cost, the incremental cost, as you mentioned, has come down to 7.3. But by when do you think the stock cost will also start sliding down towards that 7.3 mark? Or how long will it take for your stock cost of funds also to kind of get in line with the incremental cost of funds?
Yeah, I think that will take time. See, my entire borrowing book, if you see, my borrowing book is over 3 lakh crores approximately? 270.
270,000 crores. Yeah.
270. My borrowing book is 270. Quite a lot of it is on term loans which are linked to repo rates, but quite a lot of it is NCD, NCDs which are more or less fixed in nature. So the repo rate cuts would be impacting my borrowings of term loans from banks immediately. But in the NCD, I would have to wait. And then, of course, there are some borrowings which we have done in the past at higher rates. We need to retire those borrowings and churn the portfolio so that we get fresh borrowing at lower rates. So all these things need to be done so that we are able to maintain our spreads and our NIMs.
Yes, Amir, I want to add something more. So we have 45% of our borrowing is on floating rate, and that cost is gradually coming down. So ultimately, impact would be, if you consider yield rate and the borrowing cost, so the impact would be in our favor only.
Understood. Understood. Thank you so much, sir. That's it from my side. All the very best.
Thank you. We have our next question from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Congratulations on a good performance. Sir, firstly, need some color on growth because in this quarter, our disbursement growth rate was healthy. So which markets drove home loan disbursement growth in the fourth quarter? And how was the performance of Hyderabad and Bangalore versus previous quarter wherein we had an issue? And if you can also comment about whether the traction in growth is kind of sustaining in April and May, and what kind of disbursement and loan growth are we targeting for the current year?
Okay. Yeah, Rajiv, Q4 was good as far as the disbursement was concerned, a 24% growth in disbursements overall. Coming to Hyderabad and Bangalore, yeah, these were two geographical territories which were impacted in Q3 for two different reasons altogether. Hyderabad has come back on track, 100% back on track, and has delivered excellent results for us in Q4. Bangalore is now, I would say, if I were to put it on a scale, I would say 95% back on track. 5% pain we are still experiencing because of piling up of a large number of registrations which has gone online or electronic in Q3 and Q4. So I say as of now, I think both these regions are back on track. As far as what contributed to this 24% growth, I think overall everyone has done well except my East. East is slightly behind expectations, I would say. By East, I mean West Bengal, Assam, and those seven sister states. But of course, they are a very small part of my overall book and the overall share of disbursements. But otherwise, by and large, all regions have done well. This year, I'm pretty optimistic. All regions would fire. There's nothing to hold us back. The trend of Q4 gives us a lot of hope that things would continue. April has been satisfactory, I would say. Of course, not too much of growth. That is expected after a big month. In the month of March, it is traditionally expected. April month is usually so slow. May is picking up. So this year, I'm very optimistic that we would not face any problems in registering growth quarter after quarter. And I am aiming for a business growth, that means a disbursement growth of at least 10 to 12% and an AUM growth also of double digits.
Okay, great. Sir, PSU banks have been very swift in cutting new home loan pricing. They've cut it by 50-60 basis points in the last 3 months. So now is this starting to impact our BT request and BT out rates in April, May? and hence can that also drive more upfronting of a decision with regards to cutting rates? I know that a large bulk of the decision making is rests with how the funding cost should move, but because of this competition, downing their rates pretty fast, is the BT pressure increasing, and hence would we need to move slightly in an accelerated fashion in cutting our PLR and new home loan pricing?
Yeah, Rajiv, you're right. Yes, there is some BT pressure witnessed in Q4, especially for our existing loans, because banks have been very aggressive in cutting their rates, and the rates they offer to existing customers moving out of other institutions is almost equivalent to the new home loan rates, which is closer to 8%. So that is one issue which needs to be tackled, and our BT out, or rather, if I may call it in general, retention of portfolio is a major concern. Yes, we are trying to address that by being by offering on a selective basis, by offering rates to our customers who want to move out. So we've been doing that. But yes, it's a very tightrope walk for HFCs as compared to banks. Banks do have the advantage of CASA deposits and slightly lower cost of borrowings. And of course, the banks have an advantage of having other products to sell, like MSME or personal loans and other loans where they charge high rates, and overall their NIMs don't get impacted. For companies like LIC HFL, which is a single product company, as we deal only in housing loans and home loans, for us it becomes very difficult competing with these banks. So this is a conscious call we need to take. Yes, we want our book to grow, we want our disbursements to grow, but at the same time, we cannot throw margin to the winds, right? We also need margins. So this is going to be a tightrope we'll have to walk all through. And I believe we would be successful in doing that. At the end of the year, I think we would have a disbursement growth of double digits, loan book growth of double digits, and I think we would be able to maintain our margins, NIMs at 2.6 to 2.8.
Clear, sir. Thank you so much, and best of luck.
Thank you, Rajiv. Thank you.
Thank you. A reminder to all participants, please restrict yourself to only 2 questions. We have our next question from the line of Abhijit Tibrewal from Motilal Oswal Financial Services. Please go ahead.
Yeah, good morning, everyone, and thank you for taking my question. So just 2 questions. While you have kind of articulated a lot around how you're looking to grow, what margins you're wanting to maintain this year. First things first, sir, just trying to understand, first of all, congratulations to Mr. Mundra for assuming this role of CFO. And that's where my question was, what has prompted this change in the CFO role? The CFO that we had earlier, right, that he has resigned or moved on. He's still with us in the company. So, what is the thought process around this change at the CXO level? That's the first question I had. And the other thing that I wanted to understand is, last year, if I look at FY25, I personally take a lot of heart from the improvement in asset quality that we have demonstrated, which led to benign credit costs. We also know that you've been working a lot on resolutions on some of the exposures. And I think I remember somewhere in media, maybe you appeared earlier in media earlier, where you guided for some recoveries in project loans this year. So just trying to understand, how should we look at asset quality going ahead, and what is your assessment of credit costs for this year?
So let me answer why CFO change. Yeah, Abhijit, coming to your first question regarding change in CFO, this was a routine affair, not driven by anything special or anything of that sort. Sudipto Sil, our previous CFO, he had been with us for a long time, I think 9-10 years, right? The management felt that Sudipto still has some time to go in the company. The management felt that Sudipto needed some exposure in other verticals or other lines of business also. So just to give him an exposure, there was this change. Sudipto was moved into marketing, and Mr. Mundra, who is an old experienced hand, a chartered accountant at LIC, having worked in the investment department, all the 3 sections, the front office, the back office, and the mid office, a good experience of finance and investment and borrowings. So we decided to bring him in. So that was all. There was no specific any other reason other than that. As regards asset quality, yes, we've been working on asset quality for the past 2 years, and there has been an improvement in quarter to quarter consistently. If I remember correctly, 2 years back, our GNPA was 4.41. Last year, we brought it down to 3.31. This year, we have ended at 2.46. I am pretty sure the asset quality will continue to improve. The provisioning requirements would continue to come down. There will be release of provisions. Yes, legacy-wise, we still have a lot of about 9,000 crores of outstanding portfolio in default. About the project takes up almost about 21% of, or 21 to 24% of that. There are some big, sticky, lumpy loans with us at various stages of resolution. In Q3, we were able to resolve one big loan through ARC sale, 250 crores, etc., approximately. There are others which are, I would say, at various stages of settlement, negotiations going on. Some big loans being restructured. Very recently, the executive committee of the board has agreed to restructure one big loan of an outstanding portfolio of 450 crores. Restructuring comes into effect in May. Of course, as per RBI guidelines, it would continue to be in NPA for 1 more year, and after 1 year, it would get out of NPA. So May 26 is when this big loan would probably get out of NPA. And we are also ARC sales. We have just done one. But we are approaching ARCs, talking in discussion with them, talking to them to offload some other loans as well. We had offloaded a basket of loans, probably made a mistake there because we did not get any expression of interest as far as that basket was concerned. Probably, I personally feel that rather than offloading baskets of loans to ARCs, we need to offer, I would say, break up the basket into smaller chunks, which the NBFCs are able to assess and appraise quickly and probably come back with a positive reply. That is that, plus many cases in DRT, NCLT, and CLAT, etc., at various stages of, I would say, the legal decision-making process, which, as you all know, takes time. But overall, I'm very optimistic about the asset quality. Yeah, aiming for GNPA right now at 2.46, aiming to bring it down to less than 2.2. Credit cost is as low as we can get, 9 basis points is the credit cost as on 31st of March. Looking to keep it there. Worst case scenario, restricting it to 9 to 15, whatever it is. So the asset quality scenario looks good.
Got it, sir. And just one last data keeping question. In every earnings call, we share the segment-wise stage 3 numbers. So if you can just share that.
Okay, Abhijit, yeah, you usually ask for this every time, so I have it ready with me. Normally, Sudipto used to answer this. Yeah, so in the individual home loan, what do you want? You want the EAD and the EAD percentage?
Yes, sir. I mean, both the things work. If you can just share that segment-wise.
Okay, in the individual IHL, the individual home loan piece, the EAD is 2,852 crores and the EAD percentage is 1.09%. Right? In the NHC and projects, this is EAD is 3,523 crores and the EAD percentage is 24.52. In the NHI, the non-housing individual, it is the EAD is 1,225 and the EAD percentage is 3.85. And overall, the EAD is 7,600 and the EAD percentage is 2.47.
Correct.
Got it, sir. This is useful, and I wish you and your team the very best. Thank you so much.
Thank you. We have our next question from the line of Himanshu Taluja from Aditya Birla Sun Life AMC. Please go ahead.
Thanks for the opportunity. Most of the questions has been answered. Just at my end, sir, can you just throw out in the year-end interest income of the margins of 2.72? how much of the NII gets support of the resolutions of the bad assets? How much is there, and potentially is there still a good pipeline which is there for this year? Can we expect some bit of interest income recovery from those stressed assets as well? So that's my first question.
Yeah, Himanshu, coming to the asset part of it, or the recovery part of it. Yes, we still have a total EAD of 7,600 odd crores, right? And in project it is 3,523, and the others is almost near that, or a little bit more than that. So we are working on both the fronts. The retail piece loans, again, we have divided into two parts: the small loans and the big loans. Project, of course, most of it is these big ticket projects loans we have given, which are lying in default, upwards of 50 crores and all. So the project part is slightly tricky because these are big loans. Many of these are in litigation in various courts such as DRT, NCLT, and CLAT, etc., etc., etc. There it takes its own course, its own time. But at the same time, though we are in the courts, we are extending offers to these delinquent borrowers to come up and settle. And settlement also, the basic thing, what we are saying, we are not going to settle below principal, below the outstanding principal. Okay, we are willing to take a hit on the accrued interest and the interest and other recoveries, etc., etc. So there also some progress is being made in some cases. In some cases, it is out only on the courts. On the retail front, the collection efficiency has been holding up. It is good. Not too much of change in DPD delinquency is being noticed. All in all looks good from the recovery percentage, or the I would say asset piece is concerned. And what was the first part of the question?
Sir, just a first question which I have: how much of the interest income recovery, or you can say the margin support that you accrued during the year because of some of the resolutions which has happened during FY25?
Yeah, Himanshu, yeah. So recovery from NPA, that is created to my interest income. For the financial year, it was around 400 crores.
Okay, which has been passed to the NII.
Yeah, it's a part of NII only.
Okay, got it. Fair. Thanks, sir. And sir, secondly, just wanted to understand, because if we look at your project financing book has been on a continuous pace of on a declining trend, and this quarter we have seen some. How do you expect over the course of this project financing book to grow from here? And also, if you can through from the non-HL also, currently your non-HL book is growing at 11.5. How do you expect this growth run rate to be during the course of the coming fiscal year? Thanks.
Yeah, the project finance book has seen a shrinkage, and that is basically not because of any lack of focus or anything. Most of it is some of these big project finance loans which we had given in the past 3 years, 4 years back at higher rates of interest, 11, 11.5, etc. They have gone out of our books. Therein, of course, we had to take a call whether they were most of these builders were expecting rates between 8.5 and 9.5, which we felt was not tenable for us, right? Because you have to take a call between the margins and the lendings that you do. So we did try to hold on to them, but again, the rates they were asking were, in our opinion, not tenable. So we had to let them go, of course, with a very heavy heart. But as far as the book is concerned, the disbursements have been good. Project finance last year has shown a disbursement growth of almost 47.5%. But again, while saying that, this is a very small part of my book, right? Project finance is only 3% of my portfolio. Last year, we have disbursed about 4,200 crores in project finance. There again, there are two things which are driving us. Number one is, of course, the rate at which these builders are demanding. Let me tell you, this is one space where builders, at least the top-rated builders, the Shobhas, the Prestige, the Lodhas, they are asking for rates which are almost equivalent to IHL rates, 8.5, 8.25, and surprisingly, some of the banks are willing to offer them that. So we are not going into that. So we are trying to make sure that we get some decent rates which are beneficial for us. But we are focused on project in a I would say, not in a very aggressive way. But we want to grow this book. This year we have taken a target of doing 10,000 crores through project finance as against 4,200 of last year. We would be looking to grow this book selectively by looking at builders with reputation, with pedigree, with the ability to deliver projects in time, and at the same time willing to give us some margins which are sustainable.
Sure, sir. Thanks.
Thank you very much.
Thank you.
Thank you. Reminder to all participants, please restrict yourself to only 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. We have our next question from the line of Shreya Shivani from CLSA. Please go ahead.
Yeah, thank you for the opportunity. I have just 2 questions. First, just wanted this clarity on the project resolution that you spoke about. Last quarter, you said there are 4 to 5 more assets getting resolved in NCLT. So the negative net slippage that we have this quarter, how many projects got resolved over there? I mean, just some color on that. And second is on affordable housing. Now that you are closer, like you've already launched some products, etc. How many branches would affordable housing product be available in FY26 and 27? Some guidance over there would be useful. Thank you.
Coming to project loan resolutions, well, in Q4 there were no big project loans which were resolved. Q3 there was one big case which went to ARC, as I said, 250 crores. In Q4 we could not get a resolution on any of the big project loans, so as to say. So that was slightly disappointing, but again that was expected because all these big project loans are in legal dispute. Lots of disputes going on, NCLT, NCLAT, DRT. We get some order from somewhere and the borrower runs to DRT and gets our things stayed. We try to auction something and then there are cases filed in court. So these are difficult loans. I think what is left now are the difficult loans. But still we are optimistic of resolution, as I said to an earlier question, that we are exploring both ways. It is not that we want to take them to court and hang them. We are open and amenable to settlement if they are coming to us and offering some reasonable settlement. And when I say settlement, I say we have a policy here that we don't go standing principle. So the project loan, there was no big resolution last quarter. But again, these are all big cases. You never know what may turn, what may happen, what not, who might come up for settlement. So we are optimistic that this year also we would see a few resolutions. We expect at least 2-3 resolutions this year also. Let's see how it goes. But of course, you cannot give a guarantee that these are going to be resolved, right? You can only be hopeful and move in the right direction. Both carrot and stick is the legal part of it, and the carrot is the settlement part of it. We are exploring all options. Ultimately, we want this portfolio to go out of our books so that provisioning requirements do come down. And as regards affordable, yes, this was one segment which was missing from our portfolio. We were not into the affordable segment as such. We had primarily been focused on individual housing loans to the prime segment. Last year, towards the end of August, we came up with this affordable segment product. We have been slow, and it is deliberate. We have been slow in expanding into this area because we do realize it's an area where we do not have any past experience or expertise. And plus, this is an area where there is every possibility of higher delinquencies if not handled correctly, if the credit appraisal and the marketing teams are not properly trained. So we are going at it slowly. Last year in the affordable segment, we could disburse 432 crores. Yes, slightly lower than expected. We were expecting at least 1,000 crores of disbursement to come through because we had launched in August, so we had almost 1.5 years. This year also, we will be focusing more on the infrastructure and the kind of support and training experience we are able to give to people, the comfort level in handling such cases so that delinquencies don't rise. We have set ourselves a target of 2,000 crores this year. we are very clear that this is going to take 2 to 3 years for this segment to build up. And we are also convinced that this is the segment where we have to be, and this is the segment where everybody in the NBFC and the HFC space is entering. There is going to be competition, yes, but of course, this is one segment which is going to give me margins. So if I am going to hold on to my margins or increase my margins, I have to be in this segment. So 2,000 crores is what we are looking at this year.
Got it, sir. Sir, just follow up on the first question. Then, what is the recovery that has come in this quarter in the stage 3? I know you've said write-off is there of 171 crores. There are some recoveries also, right?
There are recoveries. For the year, the total net recoveries is around about 1,800 crores. In Q4, it is 650 crores. 615 crores, I'm told. So for the year, 1,800 crores of net recovery. Net recovery means recovery plus creations. So 1,800 for the year and 615 net recovery for the quarter.
Got it.
If you want to ask recovery, it is more than 1,000 crore. Gross recovery is more than 1,000 crore for this quarter.
Definitely has to be more than. Net is 1,800.
Yeah.
Gross will be much more.
Okay, sir. Thank you so much.
Thank you. We have our next question from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah, thanks for taking the question. So firstly, if you can highlight out of 32% bank loans, how much is repo linked, and out of 55% NCD, how much would be coming up for maturity or refinancing this year? Just to gauge how much of benefit we can see in the funding cost over next 12 months.
Overall, if I say my borrowing book, it's 55% fixed, 45% floating, linked to the repo rate, right? So that is the thing. And Baki, okay, you want to take over? What is the...
What was the second question?
I was saying sorry sir, the first question itself is out of 32% bank borrowing, how much is repo linked? And out of NCDs, how much would be coming up for refinancing or maturity in this year?
So for repo linked, out of 32% of our total bank borrowing, so it is all repo linked, mostly is repo linked or T-bill linked borrowings. Very few cases is MCR linked.
Okay, so MCLR is not much. It's largely EBLR and T-bill, yeah. So repo and T-bill linked, yeah.
Mostly it belongs to EBLR only.
Okay. And now just to get the sense, to get the benefit on the NCD side, on the refinancing, how much of this 55% would be coming up for maturity in FY20? Okay.
Almost 30,000 crores NCDs are going to mature. So in that 30,000 crores will be repriced. And you know, rates are now coming down, so we'll definitely borrow money on lower rates.
Yeah, that's what. Yeah. So almost 30,000 NCDs will get repriced over the year. And no chunkiness in the first half or something of that sort. It should be evenly spread across the year.
Across the year. 30,000 across the year. 25-26.
Okay, got it. Perfect. And just a clarification, this PLR, you said the entire effect will play through by 1st of July. It's not like the pass on or maybe the effectiveness will start from 1st of July. 99% of home loan portfolio will be at the 25 basis points lower rate by 1st of July. It takes generally 3 months for the entire reset. Is that correct in terms of the understanding?
Entire portfolio, we are not saying that entire portfolio will be repriced at lower PLR from 1st of July, but in most of the cases, and the major part of our portfolio will be repriced from 1st of July. In some cases, it will have monthly reset.
Okay. But majorly it will happen from 1st of July. So it will be effective from 1st of July, even though like we have reduced the rates from April, but in terms of the transitioning to the customer, it would take effect from 1st of July.
Yeah, correct.
Okay. Okay. So if you have to look at next quarter, maybe only a part which you mentioned might get repriced. It would not be a substantial one, but maybe for 1Q, it will be a relatively lower proportion.
No, Kunal, we couldn't get you clearly. Can you come
No, no.
back?
So we have cut PLR by 25 basis points with effect from April. I am saying in terms of passing it on to the borrower. Okay, it happens. So the entire 99% of our floating rate book on the individual side will entirely be repriced 25 basis points lower over the next 3 months by July, or maybe this pass on actually will take effect on a quarterly basis.
No, it's Kunal, it's like this. My entire loan book is divided into two parts. There are a small portion of loans which are having a monthly reset. So those loans where the reset is monthly, the reduction in the PLR has already been passed on from first of. Yeah, but a major chunk of the book, the reset is quarterly, right? So all those which quarterly reset would experience the lower rates or from 1st of July.
Perfect. Got it. Yeah, got it. Yeah. So this quarterly reset major portion, it starts from 1st of July.
Correct. Yeah.
Okay. Okay. Yeah. Thanks. Yeah.
Thank you, sir. We have our next question from the line of Shweta from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. So, a couple of questions. The first one, so with your increased vigilance now on the affordable portfolio, wherein we have seen regional sort of delinquencies flaring up, and also given the rate war now coming to fore even on the project loan side, so where do you see the levers to this 12% growth target? That's the first question. Second question, just taking cues from the previous participant. So given the fact that the rate transmission will be largely effective July 1st onwards, so do we see net interest margins, at least in the interim quarters, to sort of exceed 2.6, 2.7% target, which we are sort of highlighting? Thank you.
Yeah, Shweta, coming to levers for 12% growth. Yes, I do agree that the home loan market is getting very, very competitive. Yeah, with banks also in the fray. Banks having the advantage of slightly lower cost of funds as compared to NBFCs and HFCs. Yes, it's a very, very murky world there and a very, I would say, a cutthroat world there. But yes, but there is the potential. If you talk about the potential, if you talk of demand, the demand is there. And it is not that everybody wants it at 8%. There are segments of society who are willing to pay slightly higher also. So I believe the challenge for us is how do we approach those people who are willing to pay us at slightly higher rates. And just to sort of clarify, there are lenders in this segment who having NIMs of almost 5, 6, 7% also. So there is a market. Of course, they are small in size as compared to ours. They are there. But there is a market there, so we'll have to find our way into the market. Yes, it's going to be a tightrope, as I said earlier. Right? We have to be selective at what sort of cost we want to lend the loans. That would largely depend on our cost of borrowing, how much we are able to leverage our size or leverage our rating to get lower cost of funds. So I don't see any reason why we should not, because we are not abandoning the path of growth. Because there are two routes we can take. We can say that, okay, we will not look at growth, we will look at margins only. Or the other, we can say that we will not look at margins, we'll look at growth only. We are not doing that. We are trying to balance both of them together so that we get growth on the loan book and the disbursement book. And at the same time, we are able to maintain our margins. So margins at 2.72, NIM at 2.72 as at the end of 31st March 2025. I don't see any major shrinkage in the NIMs. Worst case scenario, I feel that we should be able to maintain it at somewhere around about 2.6 to 2.8. Shweta, does that answer your query?
Yes, sir, fairly answers. Thank you.
Thank you. We have our next question from the line of Rajiv Pathak from GC Holdings. Please go ahead.
Good afternoon, sir. Sir, out of this 9,000 crore rupees of the defaulter loan portfolio that you said you are carrying, what is the recovery targets that you would have for this year and the next year?
This year and the next year?
Yeah.
Well,
FY26
I think
to 27.
not going to next year, but rather focus on this year.
Okay.
Well, last year, Rajiv, last year, as I said, for the full year, my net recoveries were about 1,800 crores, right? So this year also we'll be targeting a similar amount, upwards of 1,500 crores.
Okay. So this 1,800 would be like fully written off accounts, or how would this be?
No. This would be a mix of both. There would be some accounts we would write up because we have a technical write-off policy. As per the technical write-off policy, any loans where the provisioning has reached 100%, they need to be written off. So don't do any pick and choose that I'm going to write off X loan and not Y loan. That is guided by it is a mathematical formula, so I have no leverage or leeway in saying that I will write off this and not write off that. So there will be some write-offs coming up, and other than that, there would be recoveries also. So net to net, I am targeting anything upwards of 1,500 crores this year.
So then, basically, anywhere between 800 to 1,000 crores of recoveries can flow through the P&L in terms of the recoveries or the write-back of provisions. Would that be a fair thing to see?
That would be a fair assessment.
Okay. And sir, the next question is on the yield. So how much would be the yields on our affordable housing and the retail LAP portfolio?
Well, for affordable housing, our yields are upwards of 11%. Right? We have been conscious in not pricing it too high to 13 to 14%, because we do not want to swindle the borrowers also. So our yields in affordable housing would be 11 to 12%. And on our LAP, they would be upwards of 10.5 to 11%.
Okay. Thank you so much, and wish you all the best, sir.
Thank you, Rajiv.
Thank you. We have our next question from the line of Siraj Khan from Ascendant Capital. Please go ahead. Hello, Siraj.
Siraj, are you there? I think we've lost Siraj.
Yes.
Hello?
Yes, Siraj. Siraj, we can't hear you. Can you please rejoin the queue? We'll move on to the next participant. We have our next question from the line of Rakesh Kumar from Valentis Advisors. Please go ahead.
Yeah, hello. Can you hear me, sir?
Rakesh, I can hear you.
Yeah, just slightly, taking this, query of margin, better structurally. So I was just, because banks loan, housing loan, basically individual housing loans are completely EBLR linked. And till the time we have a trajectory of, repo rate cut maybe happening for maybe another 50 or 75 bips, they will keep on passing on, right? Banks will keep on passing. And we are directly competing with them in terms of, ticket size, individual housing loan ticket size that we have. So considering that, so either we, take a hit on the disbursement pace, or we take a hit on the credit yield. So just I was thinking that, so like, the option that we have that, we do the repricing as and when our funding cost is coming down, would that, logic remain valid, considering the way competition will pan out?
Well, Rakesh, to be very honest, yes, we are competing. Yes, I did make a statement that we would link our rate cuts to our cost of borrowing. Yes, that is true, very much true. Then we will also be reviewing the competition in terms of what the competition is doing and what we need to stay competitive. Because I cannot say I will run away from the market and not be competitive and expect to grow at what we are trying to grow at double digit. So we have to be, I would say, willing to flexible in the sense that, yes, if it comes to that, if push comes to a shove, we should be able to take a call. But my guidance is that, yes, we would be careful while passing on the repo rate cuts onto the borrowers, so as to say that we have the best of both worlds. We do not compromise on growth, and at the same time we do not lose out on margins also. As I said, it's going to be tough. It's going to be very, very tough. It's going to be a tightrope walk for us. I realize that. As a company, we have to be on our toes, keep eyes, ears, everything open, noses to the ground, feet on the street. But we'll have to take a call. We'll have to be flexible and not say that, no, I'm going to pass on rates only when my borrowing costs come down.
Got it. And so just second question with respect to NHB borrowings. So the number, like as a composition, remains at around 4% of the total, borrowing that we have. So what is the scope of raising that composition further from here?
Well, NHB borrowings, Rakesh, let me be very honest. Yes, NHB offers us two types of borrowings. One is for the marginal segments, the tribals, for the Northeast, for women, for affordable. That is very competitive. We get it at around about 5.5 to 6, right? But the rest of the borrowing is at rates which are higher than what we can get from the open market. So it's a really, I would say, a catch-22 situation for us. And NHB being the, our supervisor, it does not offer us the benefit of, you take only the low-cost ones and don't take the high-cost ones. It is usually offered in a basket where they mix up the low-cost along with the high-cost. And we try to see that the average works out to at least my average borrowing cost from the market. So right now there is not too much of scope. We have been in discussion with Chairman NHB and the refinancing team of NHB that they need to be competitive. If we can, NHB is a government entity. If we can get it at 7.7, why should they get it at 8? They should be able to get it with government backing and government guarantees. They should be able to get it at lower rates. So let's see how it pans out. But this year I am hopeful that from what I hear, what I've talked to the chairman or what we've discussed, this year I am hopeful that NHB will be able to give us. Of course, now NHB has come out with a formula. They are not sort of picking and choosing that, no, I like LIC Housing Finance, I give it more. I don't like Punjab Housing, I give it less. They have come out with a specified formula, so I believe the transmission of whatever lending which LIC does will be fair and equitable. And all that we are asking them, that we need the rates also to be fair and equitable for all. So let's see how it goes.
Got it. Got it. Thank you. Thank you, sir.
Thank you. The next question is from the line of Bhaskar Basu from Jefferies. Please go ahead.
Yeah, thank you. I just had a clarification. So, of the 450 crore of income and peer recovery, which is part of the NII, how much of it came in this quarter? And secondly, the increase in other income this quarter seems to be quite sharp. So, what is driving that?
Yeah. So for this quarter, NPA recovery is around 16 crores, which we are creating to interest income.
And for the full year, this number is
615. Quarter NPA recovery is 615 crores.
615. Okay.
Impact on interest income would have been 16 crores.
16 crores.
The impact on interest.
Yeah, and for the full year, the credit on the interest income?
16 crores is credited to our interest income.
Full year.
And full year it is crores.
Sorry?
Around 400.
400 crores. And the increase in other income this quarter is due to?
Other income
96 crores going to 1.
Recovery from write-off cases. For this quarter it is 100 crores, 100 odd crores, and for the full year it is more than 200 crores.
So just to be clear, the recovery from write-off is part of the other income, and in addition there is about 16 crore of recoveries sitting in the AI.
And other income from return of cases it is more than 100 crores for this quarter.
Understood. And secondly, just on the OPEX side, there is a bump up in the OpEx. We see this seasonally in the fourth quarter. So what is it mostly commissions or what's driving that?
This anyway, every fourth quarter you normally see a bump up in your OpEx, right? Mostly it is due to advertisement publicity. Whatever is unspent or committed is booked. Then you have CSR. CSR also contributes to a big chunk of this OpEx. Competition contests because Q4 normally is a business quarter, so to boost sales, we do give contests and competitions. Not only our people on the field side. Then you have fees and commissions because business increases, so naturally fees and commission also goes up. Apart from that, this year there are two others. One is in the month of February, we just concluded our wage revision for all the 2,500 odd employees of the company. This happens once in 5 years. So of course, we provide for these wage revisions on a quarterly basis. But the provision is normally at 15%, and this year we have concluded the revisions at 17%. So that 2% gap would also have come into the OpEx. And one more thing, one change we made this year is our hardware, computer hardware, etc., whatever we buy. Until last year, it was under the capex model. Rather, we were purchasing them and capitalizing it, which would form a part of balance sheet. This year, we have decided not to spend too much of money on the hardware. Since we need it, we have gone into an OpEx model, right? In the sense that we are leasing. So if I need a server costing somewhere about 30-40 crores, earlier I would have paid the full 40 crores to the vendor and owned the server. This year we are taking it on lease for the normal SLA, the service level agreement is for 3 years, extendable by 2 more years. So I'm taking it on lease. So I don't have to capitalize it, so it is coming into expenses. So these are major reasons for this increase in expenses which you are seeing.
Okay. Understood. Thanks a lot.
Thank you. Ladies and gentlemen, this would be the last question for today, and I now hand the conference over to the management for closing comments.
Well, thank you, friends, for all the queries. I think very pertinent and to the point. And yes, thank you for giving us an opportunity to explain our views, our guidance, what we are thinking of for the company in the financial year 25-26. Let me assure you that the company is poised to deliver an excellent performance, both in terms of our disbursements, that is sales, both in terms of the loan book growth, and also in terms of margin. So the focus of the company will be on growth, margins, and the third part would be the asset quality, which has been improving and which we expect to improve further. Thank you so much for your support.
Thank you, Praveen.
Thank you, sir. On behalf of Axis Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.